Imagine it's 3 a.m. and you're not just any executive, you're the person whose signature keeps tens of thousands of employees paid. Your phone rings once. You already know it's bad news because nobody calls at 3 a.m. to say everything is fine. A hurricane has just erased your factory in Florida. Not damaged it. Not temporarily disrupted it. Leveled it. A $500 million crater where your quarterly guidance used to live. The kind of loss that doesn't just hurt profits, it invites lawsuits, credit downgrades, shareholder revolts, and a very polite email from your board asking if you're still competent. So who do you call? You don't call New York. You don't call London. You call a 21 square mile rock in the Atlantic Can Island, famous for pastel houses, turquoise water, and men wearing shorts to business meetings like it's a national religion. Bermuda. Most people think Bermuda is just a tax haven. A place where rich people hide money and nobody asks questions. That's the headline version. The meme, the easy villain. But the truth is stranger and more unsettling. Bermuda isn't just where money goes to hide. It's where money goes to work. It's the engine room of global capitalism's most delicate machinery, risk. And if that engine stalls, if Bermuda is cut off, crippled, or simply overwhelmed, the world's economy doesn't just wobble, it snaps. Because modern capitalism runs on a promise that almost nobody thinks about. The promise that catastrophe can be paid for. That the moment reality punches a hole in your balance sheet, storm, lawsuit, shipwreck, cyberattack, war, the system has a way to turn panic into a check. Bermuda is one of the places where that promise is manufactured. And the story of how it happened is not a tale of sunshine and beaches. It's a tale of desperation, legal warfare, and one quiet math nerd who essentially taught corporations how to insure themselves and keep the profits. To understand Bermuda's rise, we have to go back to the opposite of paradise. Youngstown, Ohio, 1950s. This is the era when American industry feels immortal. Steel mills roar like living animals. The air is thick with sulfur, soot, and the confidence of a nation that thinks its factories will outlast history. Enter Frederick Rice. He's not a gangster, not a politician, not a charismatic billionaire. He's an engineer and insurance broker, the kind of person who lives inside spreadsheets, the kind of mind that doesn't see business, it sees systems. Rice is looking at the books for a giant steel company, Youngstown Sheet and Tube Band. He notices a quiet absurdity that nobody else is emotionally ready to admit. They're paying millions every year to big insurers, Travelers, Allstate, the old guard, to cover mining operations and industrial risk, and they almost never file claims. When small incidents happen, premiums jump anyway. The company is paying for protection it doesn't use and getting punished for the rare moments it does. It's like buying a fire extinguisher that charges you more every time you check if it works. Rice does the thing that changes the world. He actually runs the math. And he realizes the steel company already has the cash to cover its own accidents. They don't need a middleman. They need a structure. So he asks a question that sounds simple, but in the insurance industry, it's borderline heresy. Why are we paying someone else to insure us when we can insure ourselves? His idea is elegant, almost embarrassingly logical. Create an insurance company that only insures the parent corporation. The parent pays premiums to its own subsidiary. If losses are low, the insurer keeps the profit that stays inside the corporate family. A private internal insurance loop. Rice calls it a captive because the insurer is held captive by the parent. This is not charity. This is capitalism distilled. Reduce leakage, keep margin, control the machine. But the United States government, specifically state regulators, sees this and feels something close to panic. Because captives don't fit neatly into the existing regulatory universe. The laws were built for giant public insurers with millions of customers, not private insurance structures built to serve one corporate empire. Regulators demand mountains of capital, endless paperwork, taxation at every step, and most important, like control. Ohio effectively says, absolutely not. And this is where the story turns from finance into geography. Because when you can't change the rules, you change the map. Rice looks for a place that checks a very specific list. Close to American capital, English-speaking, familiar courts, British common law, politically stable, most importantly hungry. He finds Bermuda. In the early 1960s, Bermuda is not Bermuda, not yet. It isn't an offshore colossus. It's a small British territory whose economy is painfully fragile. Its biggest export is onions, literal onions. The Bermuda onion was famous, a point of pride. Then the United States slaps tariffs on imported vegetables to protect domestic farmers, and Bermuda's onion economy starts dying on the docks. Tourism is growing, but tourism is seasonal, moody, vulnerable to recessions and storms. The island needs something stable, something that doesn't depend on sunshine. So in 1962, Rice flies to Hamilton and makes an offer that is basically a deal with history. I will bring you millions in financial flows. I will bring you jobs. I will bring you the kind of corporate infrastructure that makes an island matter. In exchange, you don't suffocate me with the same bureaucracy that killed this idea in Ohio. Bermuda says yes. That yes is the quiet Big Bang. Rice incorporates international risk management, often described as the first captive management company on the island. And suddenly a loophole appears that isn't illegal. It's just smarter than the system. Here's the mechanism, simple enough to be dangerous. A U.S. corporation pays insurance premiums to its Bermuda captive. Those premiums are business expenses, which can reduce taxable income back home. Meanwhile, the captive accumulates profit offshore in a jurisdiction with no corporate income tax. But the deeper magic isn't just tax, it's regulatory arbitrage. Rice proves corporations can shop for laws the way they shop for steel. Compare jurisdictions. Pick the one that lets you move faster, keep more capital, avoid institutional friction. For a few years, it's quiet. It's a niche solution for nerds and spreadsheets. Then the secret spreads. By the 1970s, corporate America is waking up to a brutal realization. Traditional insurers aren't just selling protection, they're selling markup. They're selling a premium on fear. And if you're a CFO staring at millions bleeding out every year, fear markup starts to look like theft with better branding. So the onion fields start disappearing. The island begins paving over its old identity. Farmers become office managers. A tiny territory becomes a financial manufacturing zone. And Frederick Rice, the math nerd from Ohio, quietly becomes the godfather of an industry that will eventually move trillions. But this is only the first phase. Captives are the seed. The real explosion comes when America accidentally creates the perfect conditions for Bermuda to evolve from a tax-efficient trick into a global insurance powerhouse. Because in the mid-1980s, something changes in the United States. The lawsuits go nuclear. And corporate America gets scared in a way it hasn't been scared since the Great Depression, when it learned that the biggest risk in business isn't always nature. Sometimes it's the courtroom. Fast forward to the mid-1980s, the neon is brighter, the hair is bigger, and the legal system is unrecognizable. If you're a CEO in 1985 chemical company, pharmaceutical giant, industrial manufacturer, you're not just thinking about competitors anymore. You're thinking about juries, about courtroom theater, about the terrifying moment when a 12-person panel, emotionally exhausted and morally outraged, decides that your company is not just guilty, but deserves punishment. This is what industry insiders call the liability crisis. It wasn't just more lawsuits. It was a shift in the culture of blame and compensation. Product liability claims exploded. Medical malpractice got hotter. Environmental cases became existential. And then there was the monster under every corporate bed, asbestos. Asbestos wasn't one industry. It touched construction, shipbuilding, manufacturing, military infrastructure, an entire era of miracle material that quietly turned into a legal landmine. Suddenly, any company that had ever been near insulation was staring at multi-billion-dollar claims. Here's what made it different: uncertainty. Insurers don't fear risk, they fear unknown risk. A hurricane has physics. A plane crash has statistics. A legal system has mood swings. And in the 80s, American juries started handing out what people in the business call nuclear verdicts. Not just compensation, punitive damages. The idea that the punishment should hurt so much it changes corporate behavior. Morally, you can argue about that. Financially, it was a disaster. Traditional insurance giants in New York, London, and continental Europe looked at the actuarial tables and realized something terrifying. They couldn't price this. Not reliably, not profitably. Not without risking insolvency. So they did something that sounds impossible until you remember what incentives do to institutions. They walked away. They stopped writing policies. They refused to cover the scariest layers, high-limit excess liability, because those layers were where the nuclear verdicts landed. Imagine being a Fortune 500 company and walking into an insurance office asking for protection against catastrophic lawsuits, and the agent just laughs. No thanks. Good luck. Corporate America was suddenly naked, not metaphorically, structurally. Because you cannot run a modern corporation without high-limit coverage. If your factory poisons a river, if your drug causes unforeseen harm, if your product triggers mass litigation, your base insurance might cover the first $50 million or $100 million, but the real threat is what comes after. The layers of excess that protect the company from being erased. Without those layers, your stock price isn't an asset. It's a hostage. And when panic hits capitalism, capitalism does what it always does. It invents a workaround. In 1985, major brokers names like Marsh and McLennan gather leaders from dozens of major corporations, heavy hitters, real economy titans. The kinds of firms that don't ask for solutions, they demand them. They propose something radical, almost tribal. If nobody will sell us insurance, we will sell it to ourselves. They pool capital, hundreds of millions, almost overnight. And then they take that money to the place that already understands the captive trick. But at a much larger scale. Bermuda, they found Ace American Casualty Excess. Soon after, another group forms XL. This is the moment Bermuda evolves. It stops being just a clever accounting detour and becomes a commercial insurance and reinsurance powerhouse. The island becomes a place where the world's largest corporations don't just park money, they manufacture stability. And here's the part most casual commentary misses. They didn't go to Bermuda only for taxes. They went to Bermuda to escape American judges. Because there's a second invention, hiding. Inside this story, one of the most elegant pieces of legal engineering in modern finance. The Bermuda form. Picture what happens when you buy an insurance policy in New York. If there's a dispute, if the insurer denies the claim, you go to court. In America, that means discovery. Juries, emotional narratives, punitive damages, media spectacle. The whole chaotic theater. Bermuda's innovators realized, you can keep. New York law, the familiar rulebook, corporations and insurers know how to play, but you can change the arena. So they created contracts that said, governed by New York law. But disputes will be resolved through arbitration in London or Bermuda under English procedural rules. Do you see the trick? You keep the language of American law, but you remove the most volatile part of American justice, the jury. Instead of 12 citizens deciding your fate, you get 3 professional arbitrators, often conservative, technical, and deeply allergic to theatrics, sitting in a conference room, looking at the math. For companies trying to budget the future, certainty is not a luxury. It is oxygen. This is why Bermuda becomes the place you go for the scary stuff. The policies, too dangerous, too political, too lawsuit-prone for the rest of the world to touch. By the end of the 80s, Bermuda is no longer an island with an offshore industry. It's an offshore industry with an island attached. A CE and XL grow into behemoths. And what happens next is predictable. Once a system works, it attracts more capital, more talent, more institutions, more gravity. But nature wasn't done testing the insurance industry's confidence. Because in 1992, the thing that insurance companies always claimed to understand, catastrophize, arrived in a form that shattered their models. Hurricane Andrew. And Andrew didn't just destroy homes. It destroyed the illusion that the old insurance system had enough capital to survive the new world. Which is exactly why Bermuda's next phase wasn't legal. It was scientific. August 1992. South Florida has seen storms before. People board up windows. Grocery shelves empty. The ritual is familiar enough to feel routine. Then Hurricane Andrew makes landfall. And nothing about it is routine. Andrew is not a storm, it is a physics experiment run at full scale. A Category 5 system that doesn't just damage buildings, but erases neighborhoods. Roofs don't peel off, they vanish. Entire subdivisions flatten into debris fields, so complete that insurance adjusters struggle to tell where one house ended and another began. When the sun rises, the number hits like a second storm. $27 billion in damage. In early 1990s dollars, just at today, that's closer to $60 billion. The insurance industry has a heart attack. Before Andrew, insurers relied on historical intuition disguised as math. They looked backward 50 years of storms. Maybe 100, if you stretched the date and assumed the future would behave politely like the past. Worst storm cost $5 billion. Fine. Hold $6 billion in reserves. Add a buffer. Call it risk management. Andrew obliterates that buffer before breakfast. Dozens of insurers go bankrupt immediately. Not struggling, not seeking capital. Bankrupt. Gone. Their balance sheets couldn't absorb the shock. The survivors, State Farm, Allstate, run their models again and realize something that chills the entire industry. If a storm like Andrew ever hits Miami directly, or New York, or Houston, the system collapses. Not one company, the entire system. Capital evaporates overnight. Coverage disappears. Premiums spike 100%, 200%, 500%. In some regions, insurance becomes functionally unavailable. You can't insure a home, so you can't get a mortgage. No mortgage, no housing market. No housing market, no banks willing to lend. This is not a weather problem anymore. It's a systemic risk problem. And into that chaos steps Bermuda again. Enter the class of '93. This is the legendary cohort of reinsurers that formed in the immediate aftermath of Andrew. Renaissance Re, Partner Re, and others that would go on to dominate global catastrophe risk. Why Bermuda? Speed. In New York or London, forming a new insurance company can take years. Regulators move carefully. Capital approvals crawl. By the time you're licensed, the market opportunity is gone. In Bermuda, at the time, licensing could happen in weeks. Investors smell blood. Hedge funds, private equity, wealthy individuals saw insurance premiums skyrocketing and understood the opportunity instantly. When fear rises faster than capital, returns explode. Billions rushed in. But here's the pivot that changed everything. The class of '93 didn't just bring money. They brought scientists. Before Andrew, underwriting catastrophe risk was part actuarial science, part educated guess. After Andrew, guessing was no longer acceptable. Bermuda became the first place where insurers stopped asking, "What happened before?" and started asking, "What is physically possible?" They hired meteorologists, climate scientists, physicists, data engineers. They built catastrophe models, CAT models, that simulated tens of thousands of years of hypothetical weather. Not history. Physics. They modeled wind speed distributions, storm surge probabilities, rainfall accumulation, secondary effects, correlated losses across regions. They quantified fear. Risk became computable. And that's when Bermuda stopped being just a financial hub and started behaving like a research campus. Walk into a bar in Hamilton today, and you're just as likely to meet a PhD in atmospheric science as a reinsurance executive. This is where disaster is priced line by line, probability by probability. There's another quiet advantage that compounds over time: taxes. A U.S. insurer makes $100 million in a good year. No major storms and pays corporate tax before building reserves. A Bermuda reinsurer keeps almost all of it. Over 5 or 10 calm years, that difference compounds into a war chest. So when the next big storm hits, the U.S. company wobbles. And the Bermuda company writes the check, then raises prices. It's brutal, efficient, and completely aligned with capital incentives. This is the moment Bermuda becomes indispensable. But even this model has a ceiling. Because no matter how good your math is, there is only so much capital inside insurance balance sheets. A truly apocalyptic scenario, Miami hurricane followed by a California earthquake, could cost hundreds of billions. And insurance companies don't have that kind of cash. Wall Street does. Which leads us to Bermuda's most audacious innovation yet: turning acts of God into securities. Turning disaster into a trade. By the late 1990s, Bermuda faced a hard limit. Insurance had been optimized. Reinsurance had been scaled. Catastrophe modeling had turned fear into spreadsheets. But there was still one problem no amount of actuarial brilliance could solve. There simply wasn't enough money inside the insurance industry. Run the nightmare scenario. A Category 5 hurricane slams directly into Miami. A major earthquake hits California months later. Flooding paralyzes Asia. The bill doesn't come in at $30 billion or $60 billion. It comes in at $200 billion, maybe more. And at that level, even the biggest reinsurers run out of capital. The vault is empty. The promise breaks. But here's the twist. The global financial system does have that kind of money. Not in insurance companies, but in pension funds, hedge funds, sovereign wealth funds, and endowments. Trillions of dollars sitting around the world, desperate for yield. So Bermuda asked a question so dangerous it permanently altered global finance. What if we let Wall Street bet on disaster? This is where the story turns darkly elegant. Enter insurance-linked securities Ls, more famously known as catastrophe bonds. Here's how it works in plain language. You manage a pension fund. You're bored. Government bonds pay nothing. Stocks are correlated with recessions. You need yield that doesn't care about the economy. A Bermuda structurer calls. They say, give us $10 million. We'll put it in a box. A hurricane with winds above 120 miles per hour hits Florida before next January. You lose your money, we use it to pay claims. If it doesn't, you get your $10 million back. Plus 10% interest. You look at the data, you run the models. You decide you like those odds. Congratulations, you are now selling insurance. But you are not an insurer. You are a gambler. And Bermuda is the casino of the gods. To make this legal, Bermuda invents a special structure, the Special Purpose Insurer SPI. It's a financial conduit. Capital flows in from Wall Street. Risk flows out to disaster zones, and traditional insurance balance sheets are bypassed entirely. This explodes. Today, nearly $100 billion in alternative capital sits inside Bermuda's ILS ecosystem. This money is not decorative. Without it, insurance in Florida becomes unaffordable, mortgages become impossible, housing markets freeze. Coastal economies grind to a halt. Bermuda becomes the bridge between people with money, New York, London, pension funds, and people with risk, Florida, Japan, California. They turn weather into an asset class. If a hurricane misses Miami by 10 miles, a hedge fund manager in Connecticut buys a new Ferrari. And a homeowner keeps their roof. If it hits, the hedge fund manager loses their bonus, and the homeowner gets a check. Capitalism distilled. But this is only half the machine. Because insurance is not a two-player game, it's a chain. You buy insurance from State Farm. State Farm buys insurance from a reinsurer. The reinsurer buys insurance for itself. This last layer has a name, retrocession, and Bermuda dominates it. Retrocession is insurance for insurers. It's the final firewall, the point where the world's accumulated risk is concentrated and passed again. Think of it like this. Risk flows downhill. From homeowners gives insurers, gives reinsurers, gives retrocessionaires, gives capital markets. And at the bottom of that funnel, there is almost always a desk in Hamilton. This concentration is terrifying if you think about it too long. Because if Bermuda fails, if a cyber-attic freezes its financial system, if geopolitical pressure cuts it off from dollar clearing, regulation snaps the chain, the entire global risk transfer system seizes. No retrocession means reinsurers can't write coverage. No reinsurers means insurers pull back. No insurers means no mortgages, no shipping, no aviation, no trade. Bermuda is not just part of the system. It is a load-bearing wall. And for decades, this wall held, until the world changed again. Because after 2008, being a tax-efficient financial hub stopped being clever and started being dangerous. Governments were broke, angry, and looking for someone to blame. Which brings us to the global crackdown and Bermuda's most important pivot yet. By 2008, the world was on fire. Banks were collapsing. Governments were bailing out systems they barely understood. And suddenly, every finance minister on earth started asking the same question. Where did the money go? They looked at balance sheets, they looked at capital flows, and eventually, they looked at the map. Small dots in the Atlantic and Caribbean began to glow like targets. For decades, Bermuda had played a delicate linguistic game. We are not a tax haven, officials would say. We are a low-tax, high-transparency jurisdiction. And to be fair, that wasn't a lie. Bermuda was never Panama. You couldn't just show up with a suitcase of cash and disappear. The island demanded documentation, identity, source of funds checks. Its secret wasn't secrecy. Its secret was efficiency. But after the financial crisis, nuance died. The OECD and the EU began publishing lists. Blacklists, gray lists, white lists. And everyone knew what blacklisting meant. No correspondent banking, no dollar access, no global finance. Instant death. So Bermuda did something that revealed just how different it was from the stereotype. It didn't fight the rules. It absorbed them. While other jurisdictions stalled, Bermuda aligned its regulations with Europe's solvency to regime one of the toughest insurance standards on the planet. It became one of the only non-EU jurisdictions officially recognized as equivalent. This was not compliance theater. It was survival strategy. Bermuda wasn't selling secrecy anymore. It was selling trust. But the real stress test came later quietly, bureaucratically, and far more dangerous than any hurricane. The global minimum tax. In 2021, over 130 countries agreed to a 15% minimum corporate tax. The explicit goal was simple: end the era of profit shifting. Companies paid zero somewhere. Home countries would claw the difference back. Pundits declared at the end of Bermuda. They were wrong. Because Bermuda made the most cynical and smartest move possible. It said, fine, we'll tax it ourselves. If the US or Europe was going to take the 15% anyway, Bermuda decided that money should land on the island, not in Washington or Brussels. The logic was brutal. Companies weren't there only for taxes anymore. They were there for specialized courts, risk expertise, deep capital markets. Network effects no spreadsheet can replicate. Leaving Bermuda wouldn't just mean higher taxes. It would mean losing the ecosystem that understands nuclear verdicts. Cyber accumulation, climate tail risk, and pension liabilities better than anywhere else on Earth. So the companies stayed. But staying came with consequences. Because while Bermuda became one of the richest places on Earth per capita, it also became one of the most expensive. No income tax meant revenue had to come from somewhere. It came through customs duties and consumption taxes. A loaf of bread, $8. Milk, $10 to $12. Rent, $5,000 a month for something modest. This created what locals call to Bermudas. One for international business expats, executives, reinsurance, math gods. Another for locals watching prices rise because global capital needs a risk hub. This tension is not theoretical. It's political and it's fragile. Because Bermuda's wealth is not fully sovereign, it is rented. The currency is pegged to the US dollar. The legal backbone is British. The capital is global. If any one of those landlords changes the lease terms, the miracle evaporates. And now, the risks Bermuda faces are no longer just hurricanes or lawsuits. They're unmodelable, cyber catastrophes that hit everyone at once. Climate feedback loops that push regions past insurability. Geopolitical sanctions that force neutrality to pick a side. Private equity insurers betting pension money on credit markets that haven't been stress tested by real pain. Bermuda has always priced risk. The question now is whether the next era contains risks that cannot be priced. If climate volatility accelerates faster than capital formation, cyber warfare creates 100% correlation events. If politics overrides contracts, then the system doesn't bend, it breaks. And if that happens, it won't just be Bermuda that fails. Florida homes go uninsured. Airplanes stop flying. Ships stop sailing. Pension checks wobble. Global trade stutters. We like to imagine capitalism as a vast, distributed machine. But sometimes it rests on a pin. Bermuda is one of those pins, not a villain, it's a hero, a workaround. A place where the world outsourced its fear and hoped math could tame it. Whether that bet holds or whether the storm finally wins is one of the most important unanswered questions in global finance.